Most people think the danger in banking is a bank robbery, a masked man, a broken window, a loud event. That is not how modern banking risk usually arrives. Modern banking risk arrives in layers. It arrives in legal language. It arrives in resolution frameworks. It arrives in inactivity rules, reporting thresholds, compliance reviews, algorithmic pattern detection, transfer delays, account closures, and the slow realization that the money sitting in an account is not the same thing as money that is instantly, frictionlessly, unquestionably available on your terms. That distinction is where almost everybody gets complacent. And complacency around money has always been expensive. I want to begin with a simple truth. Putting money in a bank does not make the money disappear from risk. It changes the nature of the risk. You trade one kind of uncertainty for another. You give up custody in exchange for convenience, payments, record keeping, and a place inside the financial system. Most of the time, that bargain is perfectly reasonable. I have used banks my whole life. I am not here to tell you the banking system is about to vanish or that every institution is on the edge of collapse. That is not serious thinking. But I am here to tell you something very few people understand until they are forced to understand it. A bank account is not a magic box. It is a legal relationship. And when the law, the regulator, the compliance department, the tax authority, or the crisis manual changes, that relationship can behave very differently from what depositors lazily assumed. That is the real story behind what people call the new banking rules. Not one giant dramatic rule that changes everything overnight. A stack of pressures, a stack of systems, a stack of quiet changes that all point in the same direction. More scrutiny, more friction, more legal pathways for delay, review, or restriction. Less innocence assumed, more explanation required. And if you have substantial savings, move money internationally, operate outside of standard retail, customer profile, rely on older habits around cash, or simply believe that money sitting in your account is yours, in the same way a gold coin in your hand is yours, then you need to think more carefully than the average person thinks. Let me start where most people never start. Failure, because the first illusion people carry is this one. If a bank gets into trouble, the government will always rescue everyone exactly the way depositors expect. That is not a safe assumption. After 2008, authorities all over the developed world spent years redesigning how large bank failures would be handled. They did not want taxpayers automatically absorbing every major banking loss again. So resolution frameworks evolved. Equity is meant to absorb losses first. Certain debt layers can be written down or converted. Uninsured balances sit in a much less comfortable position than ordinary depositors. Like to imagine the deposit insurance caps remain modest in most jurisdictions. In the United States, the standard FDIC limit is still $250,000 per depositor, per insured bank, per ownership category. Above that, you are no longer living inside the same safety promise, the FDIC's own work on resolution and deposit. Insurance reform keeps returning to the distinction between insured and uninsured deposits, especially after the 2023 regional bank failures. FASITE FATURN 290423 Search 12 FATURN 290423 Search 4 FATURN 290423 Search 8 FA. Now, I want to be precise. That does not mean every large depositor is about to wake up and find half his money confiscated. It means concentration risk inside one institution is more foolish than many wealthy people want to admit. If you keep large sums far above the insurance limit in a single bank because it feels convenient, you are effectively lending the institution unsecured money above the insured layer. That is not panic language, that is structural language. And structure matters more than feelings. The second illusion is even more ridiculous because it sounds harmless. People assume inactivity is neutral. They assume that if an account sits quietly for years, nothing really happens except maybe some dust gathering on the statements. That is not how unclaimed property and dormant account systems work. In the United States, dormant property rules are largely state-based, and after a period of inactivity, unclaimed balances can be transferred to the state for safekeeping until reclaimed. In Australia, the current bank account inactivity period is 7 years, not 3. And the law there actually moved back from 3 years to 7 years several years ago. In the UK, the dormant assets regime has expanded beyond simple bank accounts into a broader set of assets. But that is a structured reclaim system, not the cartoon version. People sometimes imagine FASITE FATURN 290423 Search 6, FATURN 290423 Search 14 Fay turn 290423 search 1 Fay turn 290423 search 9 Fay. So the lesson is not the government is sneaking in at midnight to steal forgotten accounts. The lesson is simpler and more useful. An account you do not monitor is an account you do not control well. And money that sits outside your active financial map becomes vulnerable to bureaucracy, error, air confusion, paperwork, and time. That is not dramatic enough for television, but it is true enough for real life. The third illusion is the one that terrifies innocent people the first time they encounter it. They think asset seizure always follows criminal conviction. That is a comforting fiction. In reality, some systems allow property to be frozen or seized before guilt is proven in the way ordinary people imagine. Civil asset forfeiture in the United States has created exactly that fear for years in the United Kingdom. Unexplained wealth orders are not general account confiscation tools in the way social media stories suggest, but they do exist as an investigative mechanism focused on property where authorities believe lawful income does not explain ownership. The point is not that every saver is about to lose assets to a rogue state. The point is that the distance between suspicion and friction is shorter than most people realize. Fay site Fay turn 7078875 search 0 Fay turn 7078875 search 4 Fay turn 7078875 search 11 Fay, and once your account is frozen inside a process, being innocent is not the same thing as being liquid. That is what people forget. A wealthy man can survive a legal delay and still suffer real damage. A retiree can be perfectly innocent and still be unable to access money when timing matters. Liquidity delayed is a form of risk. The fourth illusion is geographical. People believe capital controls are relics of fragile places run by unstable governments. History does not support that arrogance. Cyprus imposed capital controls during its banking crisis. Greece capped ATM withdrawals at 60 euros per Dalton Y during its debt emergency. Iceland imposed controls after its banking collapse and only lifted the remaining restrictions years later. Those were not fairy tales. Those were policy responses in real developed financial systems under stress. Fay site Fay turn 7078875 search 1 Fay turn 7078875 search 5 Fay turn 7078875 search 2 Fay turn 7078875 search 3 Fay turn 7078875 search 3 Fay turn 7078875 search 14 Fay. What does that teach you? Not that you should flee every bank tomorrow. It teaches you that access risk is a category all by itself. Money can exist on paper while being temporarily difficult to move, convert, wire, withdraw, or take across borders. When people speak carelessly about wealth, they talk only about nominal balances. Intelligent people talk about optionality. Can I move it? Can I wire it? Can I settle a transaction with it? Can I convert it? Can I reach it under stress? Those are different questions, and most depositors never ask them until a crisis asks on their behalf. The fifth illusion is that regulation only constrains criminals. This is one of the oldest lies in finance, rules built for crime. Sanctions, tax enforcement, or anti-money laundering do not stop at the moral edge where innocent complexity begins. They spill into ordinary life through thresholds, forms, reviews, suspicious pattern models, and institutions that would rather block first than apologize later. That is why transaction monitoring matters more than people think. You do not need to hit some magical public threshold to be noticed. Banks file suspicious activity reports based on patterns, context, deviations from your normal behavior, and internal risk systems. AML regimes in the United States, Canada, the UK, the EU, Australia, and many other places do not wait for cartoonishly obvious conduct. The monitoring is broad, increasingly algorithmic, and increasingly shaped by pattern recognition rather than by one giant event. Fay site Fay turn 290423 search 4 Fay turn 290423 search 20 Fay. That means the customer who says, I stayed below 10,000 so I stayed invisible, is thinking like a child. You do not stay invisible by fixating on one number. You stay less problematic by being consistent, explainable, and well documented. That leads directly to the sixth illusion, which is probably the most common foolish habit in modern banking. People think breaking a large transaction into smaller pieces makes them safer. In reality, if the purpose of those smaller pieces is to avoid a reporting trigger, you may be manufacturing a worse problem than the report itself. Structuring laws exist, and the dangerous thing about them is not merely that criminals can be charged under them. It is that innocent people with poor habits can make themselves look exactly like the pattern the system is trained to catch. A properly documented larger transaction is often cleaner than a set of awkward smaller ones that exist for no economic reason, other than threshold anxiety. The system does not know your intentions. It sees shapes. If you want mercy from an automated shape reader, you are playing the game badly. The seventh illusion is subtler and more modern. People imagine all meaningful banking control happens through lawmakers. Not always. Sometimes the pressure comes through what banks choose not to tolerate. That is what de-risking is really about. A client does not necessarily get shown the door because he did something illegal. He gets shown the door because his profile, geography, transaction type, business line, or compliance burden makes him more trouble than the bank wants to carry. Crypto, linked activity, high volume cross, border wires, politically exposed relationships, certain jurisdictions, certain counterparties, certain recurring behavior that falls outside the bank's comfort zone. The depositor experiences this as arbitrary. The bank experiences it as rationalized risk reduction. And once enough institutions behave that way, your practical banking freedom narrows even when no parliament passed a dramatic law about you personally. The eighth illusion is about taxation. Many law-abiding people hear about FATCA, automatic exchange of information, cross-border information sharing, and aggressive tax authorities, and they react in one of two foolish ways. One group panics and starts looking for magic jurisdictions where tax obligations somehow disappear. That group usually ends badly. The other group shrugs and assumes compliance alone eliminates procedural risk. That group is also naïve. The correct posture is much calmer. Follow the law. Disclose properly. Keep excellent records. Use structures that are transparent, supportable, and professionally reviewed. And understand that even clean money can become temporarily tangled if the paperwork trail is poor, the explanations are sloppy, or the institutions involved are not prepared for your profile. This is not about evasion, it is about preparation. The ninth illusion is the most fashionable one. People hear the phrase central bank digital currency and immediately jump to either utopia or tyranny. I prefer facts. Many central banks have researched CBDCs. Some have piloted, some have slowed, some have openly pulled back from the urgency of the idea. The Bank of Canada, for example, has said it is scaling down active CBDC work and shifting focus toward broader payments, system research unless a stronger public need emerges. So if someone tells you a CBDC prison is definitely arriving next Thursday, you are listening to drama, not analysis. Faysite Fayturn 290423 search, 3 Fayturn 290423 search, 7 Fay. But if someone tells you digital money architecture could eventually create more policy options for states and central banks, that is not fantasy. That is simply a recognition that programmable or more centrally mediated payment rails would give policymakers capabilities that cash does not give them. You do not need to become hysterical to see why serious savers pay attention. The 10th illusion is that inflation is separate from banking risk. It is not. If you keep large idle balances in yield accounts while the currency loses purchasing power faster than your interest income grows, the banking system may look stable while your savings are quietly being hollowed out. Most people are only afraid of losing money suddenly. The disciplined investor is also afraid of losing money slowly. A dollar that is always accessible but permanently worth less is not a triumphant outcome. It is simply a more polite form of damage. The 11th illusion is the oldest one of all. People think the default setting is safety. It is not. The default setting is drift. Drift into concentration, drift into poor record keeping, drift into outdated assumptions, drift into single bank complacency, drift into unmonitored old accounts, drift into thresholds you do not understand, drift into behavioral patterns that look suspicious because you never learned how the system actually sees you. That is what traps money. Not one rule, not one villain, not one speech from a politician. Drift now, after all of that pressure. Let me tell you what I would actually do, because I have no interest in frightening anyone without giving them a framework. First, I would respect insurance limits. That does not mean I would keep everything fragmented into absurdity. It means I would know exactly how much of my liquid cash is inside insured categories, how much is above them, and why. I would not leave large uninsured balances in one institution merely because moving them feels inconvenient. Second, I would keep active account hygiene. No forgotten accounts. No old institutions that I never log into. No balances whose ownership, beneficiary status, trusted contact, or access pathway. My family cannot clearly explain. Dormancy problems are easier to prevent than to untangle. Third, I would document unusual transactions before I need to defend them. If I sell a property, I keep the closing records. If I move money to help family, I note the purpose and the mechanics. If I make a large transfer, I maintain a clean chain of explanation. Good paperwork is a form of liquidity. Bad paperwork is an invitation to delay. Fourth, I would not structure transactions to feel psychologically invisible. I would transact cleanly, legally, and coherently. A report is not the same thing as a punishment. A suspicious pattern can be much worse than an ordinary report. Fifth, I would have more than one banking relationship. Not because every bank is bad, because optionality is good. A person with one bank has a habit, a person with several fit. For-purpose institutions has a system. I prefer systems. 6. If my life actually required meaningful international transfers, large settlement capability, or complex movement of capital, I would build my banking arrangements around that reality in advance. I would not expect a purely retail, low-tolerance institution to suddenly understand me at the exact moment I need sophistication. 7th, I would stay legal and boring in the best possible sense. No games, no secrecy theater. No fantasy about hiding from systems designed to surface inconsistencies. The modern world punishes clever little evasions and often leaves straightforward behavior alone. That alone can save a great many people a great many headaches. And finally, I would remember the simplest rule of all. Banking is not just about where the money sits. It is about who controls the terms of access when the environment becomes less friendly. That is the question ordinary people ignore. They ask whether the balance is there. I ask whether the balance is usable on my terms, at my timing, with my explanation, under stress. That is a much better question. If you ask it early enough, you do not need to panic later. And that, in my experience, is the whole point of understanding rules before they understand you.